It is 8:52 a.m. Pacific Daylight Time. It's the first day of May. It's May 1st. It's May Day. It's all the socialists dancing around the frickin' pole with the ribbons and shit hanging off of it. Woohoo! Yeah, baby. But it is May 1st, 2026. This is episode 1312 of Bitcoin, and we're going to go down and take a little trip to Brazil. Their central bank is freaking out about crypto use, so we'll tell you all about it here on the Bitcoin and podcast with me, your host, David Bennett, bringing you all the news that you can use about Bitcoin and other macro from around the world. After that, the United States Senate is going to put the shackles on themselves. Yeah. They're not going to let themselves play in prediction markets. We'll see how that one goes. Tether's profit report came in, and it's pretty astounding. I'll just leave it at that. And then non-custodial ecash mints are on the way. This is way big. This is really big. This is actually probably the biggest story that we've got going on here today on the podcast. And then after that, in the second part of the show, we're going to talk about Bitcoiners launching, quote, the Bitcoin evidence base. It's a tool to stamp out FUD, which we could always use more of that. The first, well, the drift. Remember drift and kelp and God only know the rest of the DeFi crew that's just been basically manhandled over the last couple of weeks. Well, one of the platforms is voting for recovery on kelp, but it's not going to help another DeFi protocol because of the drift exploit. This protocol is going bye-bye forever. And then we will end with Polymarket launching integrity tools. But first, Brazil. Brazil central bank prohibits crypto use in regulated cross-border payments under their new foreign exchange rules. James Hunt, writing for The Block, going to kick it off for us today, this Friday. Brazil central bank has indeed prohibited the use of cryptocurrencies in cross-border payments as part of a broader effort to bring international transfers fully within the country's foreign exchange system. That's because they want to take their cut. These are regulated payments. They can't do anything about Bitcoin wallet to Bitcoin wallet across their border. This is regulated cross-border payments. They don't want to have anything to do with crypto. The Banco Central do Brasil issued resolution number 561 on Thursday, amending rules for the EFX framework to require cross-border payments be processed through traditional foreign exchange transactions or regulated Brazilian real accounts held by foreign counterparties, excluding cryptocurrencies. The measure does not ban crypto transfers outright in Brazil. Rather, it removes digital assets, including stablecoins, from the country's regulated framework, underscoring the central bank's intent to keep international transfers within monitored foreign exchange channels. The move builds on Brazil's broader effort to bring crypto activity under financial and foreign exchange regulation, particularly as stablecoin usage has grown in the country. In November of 2025, the central bank mandated virtual asset service providers obtain authorization to operate, extending existing financial sector rules, including customer protection and governance and internal controls and cybersecurity and anti-money laundering standards, to all crypto firms. Providers were then categorized as intermediaries, custodians, or brokers, with the rules taking effect in February and a 9-month grace period offered for companies to comply. It is not the only crypto regulatory development in the country either. In March, Brazil's finance minister, Dario Durigan, paused a planned public consultation on crypto taxation, Last month, Brazilian authorities also blocked Kalshi and Polymarket in a sweeping ban of prediction market platforms, citing investor protection and market integrity concerns. Brazil remains the largest crypto market in all of Latin America, ranking fifth globally in Chainalysis Global Crypto Adoption Index in 2025. That's up from 10th in 2024. Central Bank Chief Gabriel Galipolo previously said that there has been a continued surge in domestic crypto usage over the past 3 years, with around 90% of that flow linked to stablecoin. So that's the end of the article. The fifth largest country in the world in crypto adoption, and they basically just said, we want to control all of it, and you don't get to use cryptocurrency for cross-border payment or reconciliation or remittance or whatever. It has to go through their foreign exchange. They not only does it have to go through their foreign exchange, it looks to me like their foreign exchange is not set up really to do all that much cryptocurrency, so they're just outright banning it altogether. And it all boils down to they want to know everything about it. They want to be able to take their cut, and Bitcoin pretty much allows people to circumvent that. So if for whatever reason you don't want to do that for Brazil, you can just use your Bitcoin wallet to send a payment to somebody in Brazil through their Bitcoin wallet. And you guys are the only two. It's like between you, them, and the fence post outside as to who knows what. But it's not going to stop there. It's just not going to stop there. And this is the continuation of watching people in power realize all of their power is in jeopardy. And this is a good thing. Speaking of power, the United States Senate votes to ban senators and their staff from using prediction markets. And this is Andrew Hayward for Decrypt. The U.S. Senate has banned senators from trading on prediction markets, with the chamber passing a resolution targeting potential insider trading advantages from non-public government information. The Senate resolution now prohibits senators and all of their staff from participating in prediction markets where users can bet on political outcomes, policy decisions, and other events that lawmakers may have advanced knowledge of through their official duties. Quote, United States senators have no business engaging in speculative activities like prediction markets while collecting a taxpayer-funded paycheck, period, said Senator Bernie Moreno of Ohio, who introduced the measure in a statement. Quote, serving the Congress is an honor, not a side hustle, end quote. The unanimous passage indicates bipartisan agreement that such trading poses ethical concerns similar to traditional stock trading restrictions for government officials. Is that right? Major prediction market platforms are backing the Senate's move. Kalshi founder Tarek Mansour called the action a great step in an ex-post and urged lawmakers to expand the ban. Quote, now let's pass this in the House, Mansour said. Quote, we're in full support of this, Polymarket wrote on X. Our rule book and terms of service already prohibits such conduct, but codifying this into law is a step forward for the whole industry. Happy to help move this forward however we can. Kiss asses. Minority Leader Chuck Schumer said on the Senate floor that it was a good thing that the Senate is moving swiftly, per Politico, and urged the House and President Donald Trump's administration to enact similar rules. Quote, Speaker Johnson should immediately do the same thing in the House, Schumer said. The Senate's actions follows a series of high-profile insider trading incidents involving prediction markets. In January, a pseudonymous Polymarket account wagered on Venezuelan President Nicolas Maduro being out by the end of the month, and that netted over $400,000 as a result. Last week, Gannon Ken Van Dyke, a 38-year-old active duty U.S. Army soldier, was arrested for allegedly using confidential information to place those prediction bets. Van Dyke pleaded not guilty to the charges earlier this week. State governments have also moved to address the issue, with California, New York, and Illinois issuing executive orders in recent weeks blocking state employees from using non-public information to place bets on prediction markets. Okay, so something caught my eye yesterday. It was either that or the day before, that directly relates to this Senate ban, right? There's this woman, this representative out of Florida. Her name is Ana Paulina Luna. And I thought this was a really interesting take, what she's saying here. So I'm going to read the first few paragraphs from this article from The Hill. Trump should pardon soldier accused of the Maduro bet. This is out of The Hill. Representative Ana Paulina Luna on Thursday called for President Trump to pardon the U.S. Army soldier accused of raking in more than $400,000 after betting on the capture of ex-Venezuelan President Nicolas Maduro. Gannon Ken Van Dyke, soldier stationed at Fort Bragg in North Carolina, was the guy. We just figured out he's the guy that made the bet, raked in $400,000. So she says, quote, "Maybe not a popular take, but I am calling for this guy to be pardoned unless the Department of Justice plans on going after all of the crooks in Congress currently insider trading. This is simply skewed justice," end quote. So this woman is basically saying, look, man, you either hold your own feet to the fire or everybody gets to do this. You can't have it where it's okay for you to do it. But if this guy does it, he's going to get raked over the coals. I wholeheartedly agree with Representative Ana Paulina Luna. I think that this is exactly the way that they should act. You can't screw this guy, but let everybody else off the hook for general insider trading. She didn't specifically say prediction market insider trading. No, she's talking about people like Nancy Pelosi, who clearly has been she's not there anymore, but while she was, in the House of Representatives, she was clearly using non-public government information to basically trade on the open market, and she made out like bandits. In fact, somebody did an analysis as of late and discovered that she's actually better at picking stocks, equities, and basically playing the market than Warren Buffett is. And I find that hard to believe. Warren Buffett basically has been studying this shit since he was like, I don't know, in his late teens. He's like, what, in his 90s now? And here comes Nancy Pelosi, didn't study any of this stuff, basically a public servant for the entirety of her life, in the House of Representatives for a good section of that. It's not a professional trader, yet she's whipping Warren Buffett's ass. And here comes Luna saying, enough of this. You either let him go or you start indicting everybody. And it may just fall on deaf ears, not become anything, I don't know. But I support this. I think it's high time to just call bullshit on the whole of Congress being able to dabble in the markets. You shouldn't be able to trade at all in public service at the level of the Senate and the House of Representatives, and honestly inside the executive administration and the judicial administration, although that's a little hard because the federal judges are kind of appointed for life, and that includes the Supreme Court. You got to die or resign to no longer become a federal judge. So that's a little difficult, but at least all the rest of them, no, man. While you serve, you basically got to put all your shit into a trust, and you can't actively trade it, and nobody else can actively trade it on your behalf. And that would actually do two things. That would be a de facto way to get people out of Congress. You know, like, okay, well, I've been here for 6 years and shit, I've missed 2 trading opportunities that could have doubled or quadrupled my cash, and I want to be able to trade. I want to be able to manage my money. That would literally be a de facto term of, limiting, what do they call it? Term limits. It would be a de facto term limits, because you wouldn't get a situation with Nancy Pelosi staying in public service and doing what she did for 40 freaking years without being able to do anything at all with her stocks and bonds and whatnot like that. I think it would be a great way to introduce term limits without having to vote on term limits. Will it happen? Probably not, but you get the point. Let's move on to this one. Tether posts over $1 billion of first quarter profit as reserve buffer has now reached a record $8.2 billion. James Hunt, writing for The Block. Stablecoin issuer Tether published its attestation for the first quarter of 2026 on Friday, posting a $1 billion net profit. The report, prepared by global independent accounting firm BDO, showed excess reserves had increased to a record $8.23 billion in the same quarter, supported by its continued profitability, albeit below the pace of its more than $10 billion in annual profits last year. However, the attestation provides a point-in-time snapshot of reserves as of March 31st and does not constitute a full financial audit. Tether's reserves remain heavily concentrated in short-duration, high-quality liquid investments, the firm said, with about $141 billion exposure to U.S. Treasury bills as of March 31st. That makes it one of the top 20 largest holders of U.S. Treasuries globally, alongside sovereign nations like Saudi Arabia and South Korea, and underscores its growing role in channeling demand for U.S. dollars. Beyond Treasuries, reserves also include limited other asset classes, according to the report, including gold, valued at around $20 billion, and Bitcoin worth approximately $7 billion. Quote, the diversification reflects a deliberate balance between liquidity, resilience, and exposure to macro assets that perform under stress conditions, the firm said. As of March 31st, Tether's total assets stood at over $191.7 billion, and its total liabilities at $183.5 billion, of which $183.4 billion relates to digital tokens issued, reflecting the $8.2 billion excess. Tether noted that its proprietary investments held through Tether Investments are not included in the reserves backing issued tokens and are funded from the company's excess capital and profits, and they're fully segregated from USDT reserves. Quote, our responsibility is to make sure USDT works without compromise. That means building a system that behaves the same way in any market condition, not just when things are stable, said Tether CEO Paulo Ardoino. USDT in circulation remained broadly stable during the first quarter, with total token-related liabilities of approximately $183 billion as of March the 31st. Quote, as of April, USDT continues to trade at or near all-time highs in circulation, with an increase of more than 5 billion USDT, reflecting sustained demand into the second quarter, Ardoino added. So they're printing Tether they're just printing Tether like we're printing dollars. And how do we print dollars? Basically issue treasury bills. And then when Tether buys those bills, they have extra backing, so they print more tokens. And the only reason they're doing that is that they see demand in the market for Tether. $5 billion, like in short term, like in the shortest term terms that you could use, $5 billion. And remember, Brazil accounts for like 90% of Latin American crypto usage, and most of that is in stablecoin. So just be aware. And this goes in, I can't remember who said it, but this attaches to the thought that, and I think I might have read it on the show, or I might have just read it on Nostr or something, but that there was going to be a stopgap between going from US dollars as a quote unquote world reserve currency to Bitcoin as a world reserve currency. And that stopgap is stable coins come first. And it's not surprising. It's not surprising that there won't be a leap all the way over to Bitcoin. Would I rather be Bitcoin? Well, of course, but that's asking a lot from 8 billion people walking around the planet. You know, it's just sort of the way it is. They're ruled by the old ways of thinking, which I talked about at length yesterday. On to ecash. And this is from Marty Bent's outfit, TFTC. Non-custodial ecash mints are coming to Bitcoin. This is Hal Finney's vision realized. Callie, the creator of the Cashew ecash protocol, dropped a thread yesterday that deserves a little more attention than it's getting. The announcement, non-custodial Cashew ecash mints running inside hardware enclaves are coming. The Bitcoin private keys are generated inside the enclave and never leave it. The mint operator cannot access the Bitcoin. They cannot inflate the ecash supply beyond what's been deposited. And if they try to run malicious code, transparent logs will prove it. This matters for 3 reasons. First, the regulatory angle. As Callie put it, quote, you can't access the Bitcoin, so you're not a custodian. If that legal argument holds, it opens the door for public organizations, businesses, community groups, anyone who can be held accountable to run ecash mints without taking on custodial liability. And that's massive. The entire reason Bitcoin scaling via ecash has been limited to small trust-based community mints is because running a larger one makes you a money transmitter. Remove that barrier and the design space explodes. Second, the security model. Even if attacker gains full administrator access to the mint's server, they still can't steal the Bitcoin. This is the same approach Async, ACINQ, uses to protect their massive Lightning node using AWS Nitro enclaves, a combination of isolated compute environments and hardware signing devices. It's battle-tested infrastructure protecting hundreds of millions of dollars in Bitcoin already. Third, the historical lineage. In 2004, Hal Finney built RPAL, Reusable Proofs of Work, a system that used IBM's 4758 secure cryptographic coprocessor to run a token server where anyone could verify the code running on the hardware. The server was more trustworthy than an ordinary bank because the hardware itself guaranteed the software hadn't been tampered with. Hal Finney's system wasn't tied to an existing currency. Callie's is. Cashew ecash backed by Bitcoin running in a modern enclave is RPAL's spiritual successor, except this time it's built on the hardest money in human history. Some honest caveats. This doesn't reduce risk to zero. The biggest practical risk is denial of service. The operator could simply turn the mint off and stop processing payments. But since they can't steal the Bitcoin, there's no financial incentive to do so. And if the operator used a funding source that expires like ARC, they'd actually risk losing their own Bitcoin by going offline. The builds are reproducible, meaning anyone can verify the code running in the enclave matches what's published. I've been a big believer in Cashew and ecash for a long time. Running ecash mints inside trusted execution environments is a novel approach to alleviating some of the trade-offs that exist in the ecash landscape today. We're getting closer to having everything we want: privacy, ease of use, and reduced custodial risk, all on Bitcoin rails. Progress is being made, and it's exciting to see the design constraints that exist today being explored and pushed forward. The design space for Bitcoin scaling just got a lot bigger. And that's the end of Marty's write-up over there. There's, one thing about this denial of service situation that kind of popped into my head was, what if a bad actor that just hates Bitcoin, secretly hates Bitcoin? And I'm going to pick on Michael Saylor because I don't know. I've never met the man. I don't know if he truly loves Bitcoin, if he truly believes what he says out in public. So let's just take a breath and take a step back and just think theoretically for a second. What if he decided to take all of the Bitcoin that he bought out of Coinbase and throw it into a secure enclave in ecash and then turn the fucker off? I mean, yes, I agree with Marty. There's no financial incentive to do that, but he's not going to lose his Bitcoin either, right? The Bitcoin's going to be safe. It's just completely unavailable for anything to impinge on it. When it's sitting in Coinbase, I don't know, Coinbase could be rehypothecating it for all we know. That's one of the problems. Here, at least we know it can't be rehypothecated, but it would also be unavailable for any kind of liquidity, right? It just buys, like let's say he ends up with 2.1 million Bitcoin at the end of it, and he just takes it, throws it into an enclave, and just shuts the server off. I know it sounds stupid, but what if he hated Bitcoin? What if he really, really hated Bitcoin? And he really, really was just a sock puppet for the CIA, which is, it's possible. I don't believe it, but hey, he is over in Tyson's Corner. That's really, really close to Langley, Virginia. In fact, it's like right around the corner. I'm just saying. So, but other than that, I love the entire idea of being able to prove in a logical, mathematical fashion that you are not indeed a custodian and therefore cannot be classified under any legal pretense as a money transmitter. Now, take that entire idea and wrap a mixer inside of it. Now we start getting real funky, because now there's a mixer operating on a server that you own, yet you have provable evidence that you can't custody at all. You have no idea what the hell's going on with it, and you can prove it. That'll be interesting to see if that were ever to occur. Hey, let's run the numbers. CNBC futures and commodities. Energy just getting taken to the woodshed today. Brent North Sea is down 2.6%, but it's still hanging in at $107.54 a barrel. West Texas Intermediate is down 3.7, but it's still $101.11. Natural gas down a half to $2.75 per thousand cubic feet. Gasoline down 1.6 to $3.55 a gallon. And Murban crude down 3.7 to 104.02. Metals are all in the green today. Palladium up over a point. Gold is up a half to $4,655.02. Platinum is up 0.8%, but silver is taking the goal, 3.5% to the upside. Leaves it at $76.63 per ounce, and copper is basically sideways, but it is in the green. There's only one loser, one in the red in ag today, and that is wheat, down 0.25 point. The biggest winner is sugar, 2.4% to the upside. Live cattle up a third. Lean hogs are down a half. Feeder cattle up just over a point, and the S&P is up 1/3 point. No, I'm sorry. The S&P is up almost a half point. The NASDAQ is up almost a full point. The Dow is down 0.1 point, and the S&P Mini is essentially moving sideways, but still in the green. Bitcoin chilling at $78,230 a coin. That's a $1.57 trillion market cap. And we can now get 16.8 ounces of shiny metal rocks with our one Bitcoin, of which there are 20 million. 23,000, 57.4 of. Average fees per block are elevated today. We've got about 45 blocks carrying 73,000 unconfirmed transactions waiting to clear at high priority rates of 1 sat per vbyte. Low priority will get you in at 0.3. Now, hash rate, 948 exahashes per second. That's only slightly lower than it was yesterday, and I remain unconcerned. From Bankcinos, yesterday's episode of Bitcoin, and I got Jay with 2100 sats says, thank you, sir. De-optimizing and taking my time feels good. Thanks, Bitcoin. I've also been thinking about how much, quote, Bitcoin is money, end quote, might actually drive the fiat financialization of it. That's just how they use money. It's retarded, but I guess it is what it is. Flow Capital with 1,000 says, emergency situation in South Africa. 6102 style draft regs are proposed. If passed, self-custody will be criminalized. Bitcoin community, this is our moment to stand together. Check latest Once Bitten pod for details. Holy shit. Hold on. That's worthy of a longer pause. Okay, all I can find on this is this story out of moneyweb.co.za, so take it with a grain of salt. New exchange control rules. Quote, if they pass, we're leaving South Africa. New exchange control regulations have been published, and they are the most sweeping changes announced in decades with serious implications for crypto. Speaking on MoneyWeb's Crypto Pod, Adopting Bitcoin Conference co-organizer Ricky Aldris channels the outrage felt by many in the crypto community. Some Bitcoiners believe the proposed regulations are so draconian, they would rather leave the country than place them under the control of a state. Quote, there's quite a lot of uproar in civil society about this because it doesn't just affect Bitcoin and crypto holders. This affects the gold community, the silver community, basically anything except for physical property. This is extreme overreach. It begs the question, why do we have exchange controls to start with? End quote. The outrage in the crypto community is understandable given the founding thesis of Bitcoin and the blockchain means as a means of escaping reckless monetary behavior. These regulations, if passed, will criminalize self-custody of crypto and force Bitcoin holders to move their coins onto regulated exchanges, which vastly increases the likelihood of hacks in the future. At present, that threat is low because exchange hot wallets are small. Quote, I think civil society should get upset about this. It could affect everyone. Quote, the Reserve Bank's mandate is to defend the value of the rand. Since it was founded, the value of the rand has dropped by 99%, says Allardyce. Oh, his name is pronounced Allardyce. Quote, so they failed completely in their mandate, and now they think they can tell us how we should be holding our own assets. Someone writes these regulations. We need to know who they are and what their conflicts are. The asymmetry here is crazy. If these regulations get accepted into law and you are fined for a contravention, then you face 5 years in jail and a 1 million rand fine for self-custodying Bitcoin. The person who wrote these regulations faces no sanctions at all if they get struck down, end quote. Holy shit. Holy shit, brother. Thank you for bringing that to me. Holy smokes, Flow Captain. Dude, okay. Yeah, we're going to have to be watching this one real closely. Nick Dose with 203 sats says, cheers. Cheers right back at you. Noster Gang with 101 sats says nothing, but I'm going to like his comment anyway, because I can do that in Fountain. That's the weather report. Welcome to part 2 of the news that you can use. Bitcoiners launched the Bitcoin evidence base to stamp out FUD. Brandon Lindria writing for Cointelegraph. A group of Bitcoiners have launched a new open source AI tool that generates evidence-based responses to misconceptions about Bitcoin's environmental impact energy use, and its role in the financial system. Nordic-based Bitcoin education platform Bitcoin Beyond 66 said it built the Bitcoin evidence base at a time when there is a growing body of peer-reviewed research showing the environmental benefits of Bitcoin mining, but outdated data, methodically weak studies, or plain lack of knowledge continue to negatively shape the public perception. The database seeks to offer users quick access to relevant evidence-based information about Bitcoin mining and related topics so they can share it with social media posters who have knowingly or unknowingly spread incorrect information about Bitcoin. Quote, the problem is that most people don't have time to read 22 plus peer-reviewed papers, Cambridge reports, and ERCOT data. When someone posts criticism on social media, you need a credible response, and fast. The environmental impact of Bitcoin mining has been heavily debated for over a decade, drawing criticisms. However, Bitcoin environmentalists such as Daniel Batten argue that Bitcoin mining now uses a much larger share of lower carbon and renewable energy sources. The Bitcoin evidence base works by generating evidence-based responses to Bitcoin-related criticisms submitted by users via text or links. Cointelegraph found that the Bitcoin evidence base routinely cites an April 2025 study from the University of Cambridge that found more than 52% of Bitcoin is now mined using renewable energy sources. The database also points out that Bitcoin's renewable energy mix is higher than that of the banking sector, and that more than 22 peer-reviewed studies have documented the environmental benefits of Bitcoin. BB66 said that the AI-powered database implements Batten's Bitcoin communication playbook to counter Bitcoin misinformation with evidence and empathy. This strategy includes acknowledging what was true about the criticisms before addressing the misconceptions in a way that aims to educate the person and the broader public rather than seeking to win a debate. Quote, if you're trying to own someone, you'll trigger their defenses and accomplish nothing, the Nordic-based Bitcoin group said. Bitcoin Beyond 66 tips for Bitcoiners seeking to counter FUD. That was a caption. I screwed up. I did a Ron, whatever his name is in the movie, and I just read it. The database offers 3 tones to use in response to criticism: direct, balanced, and soft. Users can help build the database by sharing papers and website links with BB66 for review before inclusion. Oh, nice. So they're going to be able to crowdsource a little bit of this. So the guys basically built a clanker that is specifically centered on combating FUD. And hey, more power to them. I haven't used it yet. Let's see if I want to make sure that there is a link to this damn thing. Let's see. Is there a link? Let's see. Let me see. I'm going to go to this about page here. Here it is. The facts.bitcoinbeyond66.com. Facts.bitcoinbeyond66.com. This looks nice. And Daniel Batten has been around for a long, long time. I have, it's a good amount of trust for this guy. So the link to what I'm looking at right now will be inside the article that I just read, and all the article URLs are in the show notes. So you just got to go find this one, and you'll be off to the races if you want to go actually look at Beyond Bitcoin 66. Arbitrum. Well, the voters of Arbitrum have considered a $71 million ETH release for Kelp recovery. If you remember, Kelp was one of the DeFi protocols that got savaged last week. A proposal to release roughly $71 million in Ether frozen after the Kelp DAO exploit has moved to an Arbitrum governance vote as decentralized finance protocols seek to reduce the fallout from one of, the largest crypto exploits of the year. Co-authored by Aave Labs, Kelp DAO, Layer Zero, EtherFi, and Compound, the proposal seeks to unfreeze the 30,765 Ether that was frozen by Arbitrum Security Council on April the 21st. Arbitrum moved the funds to a designated address and said a governance action is required before the funds can be released. As of publication, 100% of votes cast backed the proposal, representing 34.2 million Arbitrum tokens. That would be the ticker symbol on that is ARB. The voting window is scheduled to close next Thursday. The Kelp DAO exploit on April the 18th drained about 116,500 restaked Ether, worth between $290 and $293 million at the time. If approved, the frozen funds would be released to make affected RS-ETH holders whole and restore the token's backing. Subject to community approval, the funds would be released to a designated recovery address in a 3 of 4 Gnosis safe with signers from Aave Labs, Kelp DAO, Satora, and EtherFi. Yeah, so they're scrambling to figure out a way to fix this using mechanisms that basically go against every ethic that Bitcoin has. Being able to freeze shit. All right? It's just disgusting. I don't even want to read the rest of it. Let's move on to this one, because this one's more interesting. DeFi protocol Carrot becomes the first casualty of the $285 million drift exploit, which also happened in April. Brian Quarmby, writing for Cointelegraph. Solana-based decentralized finance yield protocol Carrot said on Thursday that it is shutting down permanently. Good. Becoming one of the first DeFi protocols to fall due to contagion from the Drift protocol exploit in early April. In an X post on Thursday, Carrot said that the Drift exploit was catastrophic for the protocol and had left it financially unable to continue operations. The platform set a May 14 deadline for users to withdraw any remaining funds and said it will continue to help recovery efforts related to Drift and distribute assets once they become available. Quote, "We are setting May 14th as the deadline to withdraw any remaining funds from Boost, Turbo, and CRT before we will then begin to deleverage the system." That's a bad sentence. Sorry about that. "Your deposited funds are still yours, but all leverage will be reduced to zero, freeing up all liquidity for CRT redemption," the protocol team said. And then the Drift protocol exploit, which happened on April Fool's Day, April the 1st, was the second largest in 2026. It was a highly coordinated attack that involved months of social engineering by a group of hackers who gained admin control and drained more than half of the protocol's total value locked. The contagion spread to several affiliated projects such as the yield protocol Gauntlet, the lending and borrowing platform PrimeFi, and the crypto fund Elemental DeFi. Carrot was integrated with Drift's infrastructure and used its pools to generate yield for its users. Its total value locked collapsed after the Drift protocol hack. According to data from DeFi Llama, Carrot's total value locked was around $28 million before the hack and now stands at $2 million, marking a decrease of roughly, 93%. DeFi Llama data also shows nearly $630 million worth of digital assets were stolen in April across 25 incidents, making it the month with the largest losses since February of 2025, when $1.47 billion was stolen. The $293 million hack on liquid staking protocol Kelp is the largest exploit of 2026 so far. The Drift hack is close behind at $285 million. And together, these two attacks account for more than 90% of all crypto stolen in April. So Carrot has been chewed by the rabbit. All this crap is worthless anyway. I mean, other than the fact that people lost real money, but I'm sorry that you didn't buy Bitcoin and just hold Bitcoin. It's actually not that difficult. I'm just saying. God, good Lord. Now, let's get on to this one. Polymarket launches market integrity tools following Soldier's insider trading arrest. So we're going to go back and talk about this whole bet that was made on Polymarket about Maduro being captured and this Master Sergeant Van Dyke guy getting arrested. But this is Polymarket's response. And it's written by Andrew Hayward out of Decrypt. Prediction market platform Polymarket said Thursday that it has teamed with analytics firm Chainalysis. I'm laughing because Chainalysis is a black box, man, and they are not on Bitcoin's side. But they've teamed with analytics firm Chainalysis to deploy blockchain-based market surveillance tools designed to detect insider trading and enforce compliance rules on the platform. The collaboration includes investigative tools for generating blockchain-verified evidence, on-chain threat prevention, and professional services covering training, detection, development, and complex investigations. Central to the deal is a detection model built on Chainalysis data solutions that identifies patterns suggesting insider knowledge in prediction markets. The partnership represents a strategic pivot toward institutional standards for a platform that has faced regulatory challenges. Polymarket settled with the CFTC in 2022 for allegedly offering illicit binary options contracts. It has since launched a regulated version of its platform for United States users and is reportedly seeking to bring its broader platform back to the country. Last week, the DOJ arrested and charged an active duty U.S. Army soldier for allegedly using confidential information to place bets on the platform ahead of former Venezuelan President Nicolas Maduro's capture. Gannon Ken Van Dyke allegedly used the insider info to place over $33,000 worth of bets on Polymarket in markets related to the operation and potential removal of Maduro, and then scored $410,000 in winnings. He pleaded not guilty. Yes, we know that. Quote, Polymarket was built on chain because transparency matters. And our platform shows what markets can look like when trades are open, traceable, and accountable by design, Polymarket founder and CEO Shane Copland said in a Thursday announcement. Quote, this partnership with Chainalysis pairs that transparency with the monitoring and enforcement infrastructure to back it up. The compliance upgrade comes as Polymarket experiences explosive growth. The platform first gained mainstream recognition in 2024 around election bets, but has seen surging use so far in 2026, with weekly trading volume either approaching or exceeding $1 billion for most of the year. The rapid expansion has attracted investor attention, with Polymarket reportedly seeking to raise another $400 million at a $15 billion valuation. Just this week, the platform upgraded its exchange infrastructure, introducing CTF Exchange version 2 smart contracts, a rewritten central limit order book engine, and Polymarket USD as a new collateral token. Quote, on Polymarket, all trades and all settlements are recorded on a blockchain, a level of transparency that traditional markets simply cannot match. Pairing that transparency with Chainalysis data and expertise sets a new standard for market integrity enforcement. With this collaboration, on-chain markets have the potential to be the most trustworthy markets for understanding world events, Chainalysis co-founder and CEO Jonathan Levin said in a statement. All right, well, there you go. That's the end of that article. Polymarket stepping in line, making sure their noses are clean, their T's are crossed, and their I's are dotted, all to please Uncle Sam so that they can continue allowing gambling to the good people of the United States that are having difficulty making ends meet as it is. Just saying. I mean, what could possibly go wrong, right? Anyway, so we got two things going on. South Africa cannot be allowed to do this whole criminalization of self-custody, because you don't want a single domino to ever fall. Ever fall. Because if one falls, another one might. Depends on how far away from it you are. right? And South Africa is nothing to sneeze at. It's a pretty big economy. It has its hooks into a lot of other economies. It's from a geographical standpoint, it's kind of in a catbird seat. I mean, it's like easy access to New Zealand, Australia, the Philippines, all, the rest of Africa. I mean, South Africa is a big deal. The fact that they also want to criminalize the self-holding of gold and silver and basically anything else, that's the one that really makes me wonder what the hell's going on in South Africa. If it was just about Bitcoin and crypto, that would be one thing, but clearly it's not. It's about, you can't even hold your own equities, and you don't anyway. I mean, all that, if you're like a stock market trader or you got stocks and equities and shit, you're not holding that stuff in self-custody anyway. But you can hold gold and silver and a whole bunch of other shit. You can hold a whole lot of stuff in a self-custodial fashion, and they want all of that gone. Now, they've already purged a bunch of their farmers. You're finding a lot of South African farmers coming over here to the United States because they've basically been told, we don't want you here. And they're going to Australia, and they're going to New Zealand, and they're going to like a whole bunch of other places. So they're already screwing themselves in their food standpoint. Now they're going after self-custody of anything physical or anything digital that could be held in a self-custodial manner. So this makes me think that there's something broken under the hood in the nation of South Africa. If you are South African, you listen to this show and you've got any kind of, even if you've just got a theory because your boots on the ground in South Africa, I'd like to hear it. Is everything hunky-dory with going on there in South Africa with the finances and banking and, inflation and all that stuff? Or do you sense that there's something broken? Because my gut feeling says that there's something broken, and they're taking this step so that they have first dibs if they have to do a fire sale to keep South Africa anywhere close to solvent. If you know something, please let me know. Otherwise, have an absolutely excellent and gorgeous spring weekend, and I will see you on the other side. This has been Bitcoin and I'm your host, David Bennett. I hope you enjoyed today's episode and hope to see you again real soon. Have a great day.